Hi, I'm Jason Todd, CIO for 10CAP. Welcome to Meet the Expert series.
The reality is the outlook is highly uncertain. To be fair, anyone that gives you a number with any confidence for global growth or Australian growth should be a little bit more cautious, because we need to see where these tariffs land, and it's still very much a moving feast. Now, if we look at the global economy, there will be economies that are really hit hard. Canada's a good example of that. The US, perhaps, depending on what they do in terms of fiscal stimulus. China, clearly at the forefront. And actually, our modelling shows Vietnam will be really hurt by this tariff war because they've played this central role between China and US in terms of the trade route. In terms of Australia, our modelling at the moment suggests that the current tariffs, as they stand before this 90-day review period, will take about 0.4 percentage points off economic growth. Now, that may not sound very large, but our forecast at Barrenjoey for 2025 is only 2% growth. And our potential growth, or where we should be growing, is more like 2.5%. Now, we've made a judgment on where the tariffs might end up stabilising. We think it will be lower on average than it is at the moment, particularly for China. So our best guess at the moment is knocks a 0.2 or 0.3 off Australian growth. We're likely to see a short, shallow recession in the US and perhaps in some other countries like Canada. But broadly, if we can look further ahead, 2 or 3 years, we think the global system can adjust, but growth will permanently be a bit lower because of these tariffs. One of the key issues that has occurred in the last month or so that perhaps hasn't been very much talked about is the loss of trust in the US. And so when we think about US exceptionalism, some of those pillars still exist. It's a highly innovative nation, it's a highly productive nation, long history of being that safe haven. But I think loss of trust is a really material change. And so look, for a long time I've argued against the demise of the US dollar, at least for my career horizon. You know, I think it happens over time, but I think something has broken and something has changed. Now, that doesn't mean that the US dollar or US treasuries, US assets generally are no longer a safe haven. They're just not clearly the only place that you want to put your money in uncertain times. I would think that the demise of that would be faster if there was a really obvious alternative. And that might be the saviour for the US dollar in the end. It's not clear where else you put your money that has the same level of security that we've experienced over the last 2, 3, 4 decades. So I think the US dollar and US treasuries have lost some of that exceptionalism, but not all of it. But I do think it will erode faster than it would have done if we did not have this tariff event. And even if tariffs went back to zero, which doesn't seem likely, I don't think you can regain that trust. If we look domestically and we put tariffs to one side for the moment, we are seeing in Australia inflation is coming down into the target band. The labour market is still very tight, the unemployment rate at 4.1%, so still historically very low. We've still got a lot of public sector economic pulse coming through, and we think there's some recovery in the household sector. So that backdrop would suggest that we'll have a slow and steady set of rate cuts back down to what economists call neutral, which of course is the cash rate that's not supporting economic growth or working against economic growth. The tariffs add a weaker global backdrop, more uncertainty, more volatility. So I think the Reserve Bank will be mindful of that, and I think they will respond as developments occur. Now, we think there's 2 more rate cuts coming in 2025. There may be a third, depending on how that global picture pulls out. If we look into 2026, we think that the bank will continue to slowly and cautiously cut rates. We've got a terminal cash rate, or where we think the cash rate will settle, of 3%, higher than it was pre-pandemic, but much lower than we've been. For commodity prices, much of this depends on how China responds to the tariffs and the economic hit. Remember, China also has a whole range of structural issues that we've been cognizant of for some time now. So I think net, if we think about iron ore prices, they're going to be a little bit lower than they would have been otherwise, because there will be a hit to Chinese growth, there'll be a hit to global trade, and China will have to stimulate more to try and offset that. For me, the bigger issue around commodity prices are those long-term structural issues. Demographics in particular for China. I think we're past peak steel demand. And I think we've also seen in the last 18 months that the stimulus that the Chinese government wants to put into the economy to support economic growth is not like it was pre-pandemic. And that is, they're not building homes and they're not building steel-intensive construction infrastructure. I think the stimulus will be very much focused on the Chinese household and on clearing the stock of properties. One thing I always tell clients, and I'm sure I've told you this, one of my favorite stats is for every one property under construction in China, there's 10 or 11 that are completed and not yet sold. So the stimulus will be on clearing the stock and on supporting the Chinese household, less around just boosting steel production. So look, here at Barrenjoey, we think iron ore prices will be reasonably stable over the year ahead, around that $100 a tonne level. And then looking into 2026, we've got less demand coming and of course some supply coming from West Africa. The Australian dollar reflects commodity prices, interest rate differentials, the current account, and of course global risk appetite. So history would tell us that the current period of high uncertainty, high volatility, a supply shock to the global economy, concerns around China should see the Australian dollar depreciate. And of course we have seen that in the last month or so, dipping below that US 60 cent level. But surprisingly, the currency's now rallied back. And I think one of the key unknowns now is how much do you still believe in US dollar dominance, US dollar safe haven? And that's really being brought into question. If that's no longer the place that money goes during uncertain times, then the Aussie dollar will be a bit stronger than our modelling would suggest. Now, we think it can stabilise around this US 60 cent level and slowly appreciate over the next 2 years. But I do mean into the sort of mid, maybe high 60s. Those days of averaging 73 cents seem to be well behind us. What we've seen in this election is firstly, difficulty to get any press or media for either side because of what's happening globally. If we look at the two policies though, this is an election that's very clearly been fought on two issues, housing and cost of living. And on a number of measures, we've seen the opposition simply match what the government has announced. Medicare is a great example of that. There are some differences though. Obviously, the coalition has announced a fuel excise cut, for example, some different housing type policies. If we look over 4 years, which is what the budget papers will give us, both sides are actually spending about the same amount of money. But the coalition's policies are a little bit more front-loaded and they would argue temporary in terms of things like the fuel excise. I think for markets and for economists, what's missing, and I hate to say this, but reform, productivity enhancing reform. And in a world that is less certain, more protectionist, higher geopolitical uncertainty, having a productive domestic economy is critical. And so I hope that once the election passes and inflation comes down, that we can really start to address this productivity issue. I'm nervous about the next 6 months. We're a small, open economy, and there's a lot of gyration happening in the world, and we can get buffeted by that. And we don't have, as we just discussed, a strong, robust, productive economy. So I am concerned about that. I am deeply concerned about the housing crisis and the energy crisis that we have in Australia. I think about those two things actually in a productivity sense. We know that if young Australians can get into the housing market, they're more likely to be able to borrow money, they're more likely to be able to start a productive, innovative startup. And of course, we know that for businesses, energy is critical. Reasonably priced energy, reliable energy, and a clear path to transition. So I think we've got some really big challenges. We also have some important tailwinds, and look, I'm a glass half full person, as you know, Jason. So like on the upside, we are a relatively young population. We are still a very desirable place for migrants to come. Migrants bring demographic tailwinds and productivity tailwinds. It's a great place to live. So I think we have the opportunity to have a really rich future, but I think we've got some things that we really need to start to tackle, and they require a national narrative. We need to fix housing, we need to fix energy, we need to be more productive, and those things are more critical in a less certain world.